Welcome, everyone, to IREI Live, the future of real estate investing in gateway markets. Today, as the title indicates, we're examining gateway markets more in depth today. So we've seen a migration away from gateway markets, which has caused smaller markets to outperform in recent years, with an acceleration of this trend occurring as the pandemic began in 2020. Real estate investors have arguably been slow to price this risk in, but cap and discount rates are now wider in markets such as Chicago, San Francisco, DC, New York, than in places like Atlanta and Phoenix, in our view. So today's presentation and discussion will highlight MetLife Investment Management's expectations for real estate performance in gateway markets. And I'm going to ask each of our speakers from MetLife to introduce themselves with their name, title, and some quick bio highlights. So I'll pass it over to Will, Jeanine, and Matt, and they can take us through this webinar. And thank you, all of you, in advance for taking the time.
Well, thank you, Chase, and welcome everyone. Thank you for joining. So my name is Will Pattison. I lead the real estate research and strategy team for MetLife Investment Management. And just so you know who we are, we manage about $110 billion in private real estate on behalf of around 75 institutional investors. So Jeanine, I'll pass it over to you.
Hello, my name's Jeanine Lester. I head our DC regional office. It's one of 7 regional offices we have around the country. I've been with MetLife over 18 years. I've been in the DC office for 4 years. Prior to that, I was in our San Francisco office. I've done mortgage lending, acquisitions, and joint ventures on the transaction side before moving into this role heading up the DC region. I'll turn it over to Matt.
Thanks, Jeanine. Hi, everybody. My name's Matt Sharples. I'm a managing director and head of the Chicago regional office. I essentially have the same job Jeanine does. I just do it here in the Midwest. So I'm responsible for debt and equity investing throughout the 13 states here in the Midwestern part of the country. I also have another role. I'm a portfolio manager for one of our real estate equity separate account clients. I'm a Midwesterner, born and raised in the Detroit area. I've been in Chicago many years since I went out to school there. Little fact, just yesterday, I celebrated my 24th anniversary with MetLife Investment Management. So I've got you beat by a few years, Jeanine.
Well, a belated congratulations, Matt.
Thank you.
That's good. So I think our plan or our outline for today's call is I'm going to start by going through just briefly our overall market outlook, so you at least have an idea as to where we're coming from, and then Jeanine's going to discuss some dynamics in the DC market. Matt's going to discuss the Chicago market, and then we're going to go through by property type how the performance has been during the pandemic and some of our expectations going forward. Please feel free, if you'd like to submit questions during the Q&A portion. We are counting on some questions. I'm not sure we have an hour's worth of content here, but I hope that we can get at least a few so that we certainly have made time for it at the end. So I'm going to share my screen here because I have some slides to go through. And as I go through the market outlook, Matt and Jeanine, feel free to flip your cameras off if you like, because you get a 10-minute break now before we kind of come back together. So hopefully everyone can see this slide. So just briefly on the economy before we jump into real estate markets. High frequency data, such as the price of copper depicted on this chart, suggests that inflation is now declining, even though if you look at the CPI or PPE readings that have been released by the government in recent months, we're not really fully seeing that yet, or at least not to the extent that more real-time indicators are showing. Housing costs, which is something that we in a real estate group have even more insight into on a real-time basis, have also been leveling off. And so the 8.1% inflation reading on this chart, which is kind of the year-over-year figure as of the third quarter, is now we're pretty confident to say a lagging indicator. And that was not something we had kind of a high conviction view on even just 3 or 4 months ago, but we now certainly agree with what I think the market consensus is also becoming, which is that inflation is declining, and we think inflation will be down to kind of the 3% or even below 3% sort of long-term average level by the end of next year. In terms of the 10-year Treasury, we also think that's going to be declining. We are expecting a few more rate hikes, but we believe the Fed will be cutting rates during 2023 and expect a 2.75 10-year Treasury rate by the end of the year. In terms of kind of national level dynamics that are occurring, one of the biggest surprises to us over the last year has been how much new construction has started in the office sector. We were expecting the effects of remote working and kind of softening office demand to provide some relief to the supply-demand fundamentals. But because there's been so much demand for Class A+ quality or trophy quality office assets, it is still kind of penciled out for developers to build new office space. And as a result of that, the supply pipeline, as I mentioned, has been a surprise to us as to how high that has been, including projects that were breaking ground in 2021 and even during the first half of this year. Net leasing, as the slide indicates, has actually been relatively strong over the last year, despite this work from home effect. But again, the supply pipeline has been a fairly negative kind of development over the year. In the apartment sector, fundamentals are healthy, but they're certainly moderating. I think apartment rent growth hit its highest calendar year growth level ever in 2021. And during the first half of 2022, apartment rent growth remains strong, but we've seen that level off over the last 3 or 4 months, and kind of national average readings indicate that apartment rents have been approximately flat on a seasonally adjusted basis, about -1% on a not seasonally adjusted basis. The one upside for the apartment sector that has certainly been occurring over the last 4 or 5 months has been the buy versus rent calculation increasingly favoring renting as mortgage rates moved from in the 2.5% to 3% range a year ago to more like 5% to 6% today. Not quite as high as the 7% level a few months ago, but still well above where they've been over the last 3 or 4 years. And then just lastly, on the retail and industrial sectors, the retail sector has been performing surprisingly well this year, despite e-commerce headwinds. The chart on the top right corner depicts e-commerce spending as a share of all retail spending. And there was a question a year and a half ago that we were asking and many real estate investors were asking, which was, what's going to happen with e-commerce? Did the pandemic essentially pull forward the e-commerce spending that would have occurred, or that growth that would have occurred over the next 5 years? Or was that spike in e-commerce spending temporary? And it now seems to be that it's a little bit closer to temporary, since again, that e-commerce spending chart shows that it's fallen back down to something like the trend line would have suggested had this pandemic never occurred. That has resulted in strong brick and mortar sales, or brick and mortar sales have at least been much stronger than we were expecting, and I believe many of the retailers were expecting. Leasing demand has been strong, and occupancy rates are now near all-time high levels in the retail space, which again, that was a surprise to us as to how strong that's been this year. And then just in the industrial sector, lastly, industrial continues to perform well, even though e-commerce sales volume has contracted a little bit, or is not as strong as some might have been hoping a year and a half ago. Demand for faster delivery speeds has been driving e-commerce, or has been driving industrial leasing rather very well over the last year. And one kind of misconception that I think exists in the industrial space is that e-commerce sales volume have been the primary, or in some cases only, driver of all of the demand that's benefited the industrial sector. Really, those delivery speeds have been equally, if not more important. So for an e-commerce tenant to be able to deliver goods in one day or same day, they might need something like 5 to 10 times the warehouse footprint than they would need if they were doing 1 week deliveries, or were able to store all of their inventory in one location and then just mail it via slower methods, as opposed to needing to store copies of all their inventory in all of the major markets, which is what most online retailers are moving towards today. So that's kind of our national level view. Matt and Jeanine, if you want to jump back on, I thought we could now move into some of the markets. So Jeanine, maybe you could get us started and kind of just discuss the DC market in general, or if you have any observations as to how it's performed, or why you think there are good opportunities in DC. I'm sure the audience would love to hear that.
Thank you. Yes, the DC market has not been as strong a performer lately, but there are still a lot of good reasons to focus on it, and we continue to find good opportunity here in the market. Of course, we're the nation's capital. We're the 5th largest metro area in the country. Lowest employment volatility and unemployment rate historically. We're among the top 5 metros in terms of educational attainment, and over half of the population, the adult population, has a bachelor's degree. So all these things lead to an income that is 1.5 times the national average. We have the 2nd highest median income in the nation in this area. We also have high income to rent ratios, arguably the highest in the country, which is good for multifamily. There's the stabilizing effect of the federal government employment, which comprises about 30% of total employment here in the DC area. And DC companies receive a disproportionate share of federal spending from federal contracts. And we were the fastest metro to recover following the GFC. And the conventional wisdom was that the DC area is somewhat counter-cyclical. That hasn't totally been the case this cycle. That's how they got me to move here, but it's been a little different this go around, and it really has to do with the federal government. One of the things that it has to do with, I should say, is the federal government not, returning to work in the same way that, private sector has been. But aside from all of that, we're also, the 2nd highest concentration of tech jobs in the country. We have Amazon HQ2. We're the data center capital of the world out in Northern Virginia. The Virginia Tech Innovation Campus is one of the things that drew Amazon to the area, with $1 billion being spent on a new facility that is going to produce, 30,000 computer science and computer engineering graduates over the next 2 decades. We've seen Meta, formerly known as Facebook, expand in DC. Microsoft is expanding in Northern Virginia, and the I-270 corridor is home to the 4th largest life sciences concentration in the nation. So all of these things, still warrant consideration, and there's still good opportunities to be found that leverage, some of those strengths.
That makes sense, Jeanine. That's a good primer. One just clarifying point, you mentioned government employees not returning to office the same way private sector employees had. Our view, kind of the MIM view on where that return to office is going, is that something like 6% of pre-pandemic office employees are moving to full-time work from home, and then many, perhaps the majority of the other 94% are going to be in some type of hybrid environment, like maybe 3 days in the office or 4 days in the office. But your point about government employees was that they're returning or at least the physical occupancy is lower than private sector
Correct.
employees. Is that right? So they're not at the 3 to 4 day spectrum that most of us in the
That's
private sector
correct.
are?
The charge for a lot of the federal agencies has been to come into the office once per paycheck, per pay period. So that's once every, 10 business days. So you can imagine how that impacts, metro ridership and the coffee shop on the corner and, all of those things. So that, because it does comprise such a large percent of our overall employment, has been, I think, something, contributing to the slower recovery this time.
It seems as if even though physical occupancy is down, the government has been renewing leases though, or not downsizing, right? Or are you aware of any trends there? Or is that
There is
mixed?
one recent bit of news in Alexandria was the U.S. Patent and Trademark Office. They renewed, but they renewed for 2/3 of their space.
Oh, okay. So a little bit of downsizing, which we've certainly seen that amongst some firms in the private sector as well. So, okay. Well, good. Yeah. Thanks, Jeanine. Matt, maybe we can switch over to Chicago. Could you also maybe give us a primer or what your expectations are for future investing in the Chicago market?
Absolutely will. Hearing Janine's description of the DC market, it makes me think that, probably each of our gateway markets could make its own case for attracting capital. The DC market has its own specific, reasons for that, and so does Chicago. And historically, the case for Chicago has been a pretty easy case to make for investment. It's a large and deep and a liquid market. It's the third largest metro. Depending on how you size the metro, anywhere from 7 to 9 million people and 3 to 4 million jobs. It's the most economically diverse large market in the country. So the economy in Chicago area most closely matches the overall U.S. economy. It's not overly reliant on one sector or industry. So that's really provided resiliency through cycles over the years. It's, of course, the business and cultural center of the Midwest. We've got, I think, 36 or more headquarters for Fortune 500 companies. It's a vital transportation and distribution hub for the country, linking the east and west coasts via the railroads. It's got great infrastructure and its airports and roads. And then it's an affordable city compared to many of its coastal peers. For residents, the cost of living is quite a bit lower than other markets. For example, rent as a percentage of household income is only 15% market-wide here in Chicago. That's probably a third of the rate that it is in Manhattan, and half what it is in Miami or Seattle. So that's an important consideration for the talent that moves here. It's also generally a lower cost of labor for companies that office here. And we have a very huge and talented labor pool. Chicago is the #1 destination for Midwest graduates in STEM jobs, engineering, business, and computer science. Downtown Chicago gets typically about 9,000 new graduates moving to Chicago every year. And I think that has in large part to do with its importance in the Midwest, but also its central location among an awful lot of well-regarded universities. So those are some of the things on the list that come to mind for making a case for Chicago investment historically. And while Chicago does have some challenges that we'll get into as the conversation continues, I think those foundational strengths are going to continue to underpin good investment opportunities going forward.
Yeah, thanks, Matt. That's that makes a lot of sense. I'm wondering, during the pandemic, were there any trends that in particular you saw that have implications recently, or any changes outside of kind of the macro picture or the long-term picture that you outlined? And maybe I'll throw two questions to you at once, since I saw one got submitted. The question that got submitted is: the Fulton Market area the only strong area for Central Business District Chicago? There's a couple items for you.
Yeah, so we'll jump right into the challenges. It sounds like, and by the way, Will, your audio was the volume on your audio was a little bit low for me, but I did hear most of that.
Okay.
So yeah, some of the more recent trends, in my view, have been a little worrisome. In my perspective, successful real estate investing is built on optimism. You need to know that your exit price is going to be higher than your initial price. Your rents are going to grow, those kinds of things. And lately there have been some, some trends that have probably increased pessimism among Chicago investing. Some that come to mind are, population declines. Chicago is a very large market, but it's not a fast-growing market, as we all know. And its growth overall lags national averages in many of its peer markets. The financial situation for state and local governments has been under a lot of stress, with unfunded pension liabilities and even operating shortfalls in some budgets. And then crime, both the perception and the reality of crime certainly puts a damper on investment. The homicide rate gets a lot of talk in Chicago, but a recent analysis of some crime lab data by Cranes Chicago showed that while the overall crime rate for the total city was on like a 25-year high, the results by neighborhood really varied quite materially. And in fact, the four north side precincts or neighborhoods on the north side of town, were the safest in over a generation. But that's, offset by crime on the west and south sides of the city that, are quite prevalent. So anyway, there's a crime issue, and the perception of that and the reality of that, I think, really affects investment. So Will, those were some of the trends, worth highlighting. And I think the question you asked was about Fulton Market. And that is, in fact, a bright spot. I'd hope to touch on that when we got into the office market, but I will say, in the overall scope of sort of a challenging market, the Fulton market has been, by many counts, the best performing office submarket in the entire country over the past 5 years. It's a small market, and I think that helps on the statistics, but it has, captured more than its fair share of net absorption and increasing office rents and in-migration of companies and residents. So that's been a successful highlight for the Chicago market.
Okay, good. Well, thanks, Matt. Is my audio a little better now, or?
It is, thanks.
Okay. Well, apologies if I was a little too quiet during the first portion of the call. So, Jeanine, we talked about, or you mentioned rather, the government leasing trends. Are there other trends that have occurred more recently during the pandemic? And then I'll also throw you two questions at once, since we had one submitted. What is the status of adaptive reuse in DC, such as office to residential? I'm not sure if your office has been exploring a lot of those, but
Sure.
Observations there. Yep.
Sure. Well, I have to go back to pre-COVID to start the story. So there was a fair amount of new supply in the DC market, headed into COVID. And then, we're among the slowest in terms of return to office. A lot of that, I think, impacted by some of the trends I talked about in, the federal government. So with all of those factors, there's certainly been increased office vacancy, more uncertainty about the timing to lease up space, about concessions and rental rates. And what you talked about at a national level is absolutely happening here. There's a big divide between, Class A trophy space and other product. And there's a real flight to quality. There's clear preference for it. I would say, in general, it is a company will take less space that is more premium and more expensive on a per square foot basis, but because they're also taking less square footage overall, still is a reduction in their real estate costs, and they're able to provide, their employees with, just an amazing office experience. And some of that is to help draw folks to come into the office. So, I think some of that is playing out in the market right now, and there's going to be, winners and losers. And, some of the lower quality product may not, see its highest and best use continue to be office. And we've certainly seen a fair number of office to primarily residential conversion. And, I will say, we haven't invested in one ourselves, but, we're keeping on top of it and, looking at opportunities from time to time. And I will say that, it's not the easiest thing to do. I'm sure folks who've done it, have even more data, but the floor plan may not be ideal for conversion to residential. So you get units that, aren't as desirable for residential. And so it doesn't get the same, rental rate as designed multifamily product. And, costs have gone up, construction, financing availability has reduced, and it's also more expensive. So all of these things make it, that much harder to do some of those conversions. I think it is beneficial to our market to remove some of that obsolete supply. And, there's a place for it. We talk about one thing maybe jurisdictions could do is to, help incentivize it. It is good from the perspective of you're able to cut time out of the schedule. But given all the increases in costs and everything, folks are saying, that the value as a residential conversion has been declining. And, some of those trades have happened in the 200s per square foot. So that's often not a value that is desirable for a office owner.
And Jeanine, when you said cut time out of the schedule, was that meaning a conversion?
To construct, yes.
A conversion from office to residential as opposed to ground up construction?
That's correct, because you don't have to excavate and, do the parking garage. Maybe you're able to utilize what's already there, and then the physical frame of the building. But there, it does take time and money for the demolition.
Yeah, okay. It is, it is a good question, outside of just DC, but at the net that, sorry, I think our webinar had a recording issue. I have thought that the office to residential conversion would be happening at a more meaningful scale than it is. And in part because of how much residential prices have gone up. And when at least looking at the national level, that just the number of conversions that have occurred, it's really not a material positive impact to the office sector, which is what I had been hoping for. It's estimates are something like 0.2 or 0.3% of office stock has been converted to residential at the national level. And if you'd asked me a year and a half ago, I would have been hoping for more like 1 to 2%. So almost 10 times the amount that's actually occurred. But maybe it's just in progress
It's
and
the
that will continue in
challenges.
the
Yeah,
future.
I think it's all those challenges, the physical challenges, as well as, the costs have continued to increase, and the complexity is, enormous with some of those conversions, because you're working with something that wasn't designed for its ultimate use.
Okay, well, I think we're about halfway through, so I definitely want to get to the next portion where we kind of go through each of the property types and discuss what's actually occurred. So let me reshare my screen here. So assuming everyone can see this screen that's loading, what we have put together is essentially real estate performance by market and by property type. So the performance measure here, though, I want to talk through just briefly. So we're going to start with the office market, and there's a couple columns here. The first column is revenue per available foot, and that is essentially the market rent, an estimate of what the average market rent is per square foot multiplied by the average occupancy rate. So this does not represent revenue from existing buildings, which have much more kind of complicated tracking, such as existing leases. This is really kind of market rent today. It's sort of a theoretical measure of market rent today, again, times the average occupancy level. And then in the next column, that's probably in theory the better measure. That is the unlevered annual rate of return by each market during the pandemic period. Although this kind of has issues in that not all the markets are covered by NACREIF just due to not having a statistically significant sample size. There's also a couple other issues, such as even markets that do have a number of assets. There may be medical office in here making up a disproportionately high share, or life science in here. So neither measure is probably a perfect way to rank which cities have performed the best, but we thought that this revenue per available foot was at least something we could sort by. And certainly, as you can see on this chart or on this slide, the gateway markets have generally underperformed. Those are the markets that are in yellow as a result of migration trends essentially out of those cities during the pandemic and other factors. San Francisco was the lowest performing sector based on at least the RevPAV measure. That's because it's had, as much as other gateway markets, out migration of companies and people, and tech workers, which are prevalent in San Francisco, or tech companies, have been a little quicker to adopt work from home and give up leasing space. The New York market, just briefly on that one, has actually had pretty strong leasing activity over the last year. But the New York market also has the highest construction pipeline in the country, coming online last year and this year, just as measured by total square feet coming online. So that's sort of been offsetting what otherwise might have been a pretty good boost to supply demand fundamentals. So that's just, the high level on the gateway markets. You can see at the top of the list, a couple Florida markets certainly are there, and that's because some of those companies migrating out of places like San Francisco or New York have gone to Florida, and that's been a tailwind for demand in that space. So maybe, Matt, we could start with Chicago. The Chicago market was, I believe, 14% vacant in 2019. Today, it's around 20% vacant. So it certainly has struggled, at least at a sort of metro level average, as much as most of the other gateway markets have. Are there any kind of nuances to that, or any ways you're thinking about Chicago office, or is this a sector we should, investors should just generally stay away from? Or what, do you have any thoughts on kind of what's happened there and what that means for the future?
Well, I'll have to admit, Will, that Chicago office investing, it's not going to be for the faint of heart over the next couple of years. That's for sure. But I think if you have the right strategy, you stay disciplined on your underwriting, you've got some patient capital, I think there'll be some opportunities that you can take advantage of, because there is stress in the market. primarily in the class B and C, or even some of the A- type buildings are showing signs of stress. So I think we're in the early days of seeing a lot of resets on basis. Owners are going to capitulate, with pending loan maturities and a lack of affordably priced debt. I think we'll see, some owners capitulate to, be forced to sell, perhaps at any price, or just hand back properties to lenders rather than invest the needed capital in tenant improvement work, amenity work that Jeanine was talking about. So it's not a rosy view of the near-term outlook for Chicago office investing, but I do think there'll be some opportunities there if you have the right approach. Listen, Chicago is clearly a tenant market right now. It has been for a while, but landlords getting squeezed on lease economics, lower face rents, significantly higher TIs driven by tenant leverage and also inflation, more free rent. I mean, I see lease deals cross my desk that are approaching negative net effective economics. So not a good place to be in. And then, we talked about amenity floors and perks for tenants to get their employees back into the office. Jeanine was mentioning that in DC. It's very much an important feature here. If you have an older Class B or Class C building that does not provide modern amenities for companies' employees, you might not even make the tour list. And this is extremely important because Chicago is still less than 50% on its return to office metrics. So, well below pre-pandemic occupancy levels. And then I did talk about Fulton Market in response to the question we had earlier. That is a bright spot. It's a startlingly different kind of environment in that western part of the downtown area. But it's a small market, right? It's only about 7.5 million square feet, but it continues to show, very strong performance. There was a large office building that was delivered at the very start of the pandemic and leased up to 100% during the pandemic at market leading rents. So there could be some opportunities out west there. And then finally, I think from my perspective on office investing, just to kind of broaden the view from equity, I think there'll be good debt opportunities. There'll be some good commercial mortgage loan opportunities in office investing where investors can get good yields and have the debt appropriately structured with reserves or features that will make that debt look very secure. And there will be opportunities for, certainly higher yielding investing in mezzanine space or preferred equity to kind of, rescue capital to kind of fill some of the gaps that are going to be prevalent, I think. So those are kind of my thoughts on Chicago office in the near term, though.
Well, that makes sense, Matt. And the item you highlighted on sellers maybe being forced to sell. My little quiet.
Yeah, your audio seems to come in and out, but
okay.
I can hear you. I just have to concentrate more than normal.
Is that any better? Or
it is, yeah.
okay, I think Zoom is automatically adjusting my volume level, so I put it on manual. But you mentioned Chicago office sellers maybe having to sell at any price, and when you say something at that level, that certainly seems like there could be in some cases attractive options, even if we are assuming a pretty negative economic outlook. And I know that our teams have worked together on underwriting kind of long-term office rent growth or rent changes, and we're underwriting pretty low rent growth over the next 10 years in the office sector. And so if the price is right, though, that doesn't mean that there's not going to be opportunities. Jeanine, maybe the same question over to you in the DC office market. Are there opportunities there or nuances worth exploring?
Yes, I agree with a lot of the points that Matt made. They apply here in DC as well. I'll add a few others. I would say that it's always about, selecting the right properties, but it's probably even more important than ever in terms of winners and losers with the types of offices and the location of offices that tenants want to be in. So that's one factor. And, it's a lot of it is about vintage of building and newer product, garnering a lot of that demand, even at a higher price. The other thing I would say is the, subcategories within office. So this year we bought an investment in the I-270 corridor of Maryland. It's a life sciences building. It was a core investment, fully leased. That submarket has less than a 2% vacancy, and is home to the National Cancer Institute, the Food and Drug Administration, Adventist Health, the University of Maryland, et cetera. And so there are some bright spots with that. We're also looking at medical office opportunities. The investment can be higher up front, but you tend to have a pretty sticky tenant, and it's not as influenced by an economic downturn, if that's what we're headed towards. So there are still some of those bright spots out there on the equity side, but on the debt side as well. A couple weeks ago we did close an office financing out of this regional office. In times like this, you can underwrite more conservatively, get more credit enhancements, and really make good, solid loans with relative value. And, in some ways, it's good to have the boots on the ground to differentiate between which, properties you think have that ability to stay at the upper end of desirability for tenants.
Excellent. Yeah, thanks, Jeanine. So just doing a time check, we probably should keep going on. We could probably talk about office for an hour alone. But moving to the retail sector, the slide that I believe everyone can see now, San Francisco is again at the bottom of the list here. Nashville is one that's done very well. It's currently at a 2.9% vacancy rate. That's one of the lowest vacancy rates across the whole country, and the lowest Nashville has seen in a very long time. So, Jeanine, maybe on Washington, D.C., RevPAV, the measure that we're using here, was negative in the case of office, but is positive in the case of retail. Does that track approximately what you're seeing, or do you think this data seems accurate that you've seen a little better revenue growth in the retail space?
Yeah, I would say that within our portfolio, and we have debt and equity investments in retail in our region, and we have a variety of different product types as well within retail. It generally performed well during even COVID. There was some impact, and DC was, one of the slower to basically allow for return to normal business. We had the mask mandate for longer and more, cautious policies. But in other parts of the metro area, like Virginia, there was a quicker return to normal. So, generally everything performed fairly well. And I would say, you know, a lot of our centers have a component of grocery or necessity retail, which, you know, is probably a factor in their performance. You know, the one that was maybe a little slower to recover, we have an urban retail investment. It is now fully leased, and we had a restaurant tenant in a portion of the space that was vacant previously, and we have now released that space as well as another piece next to it to a daycare. So we are, you know, filling with some more necessity retail, and you know, we saw essentially the retail recovery in the urban areas with more residential first, just because of the return to office dynamic that we've talked about before. But I will say, I guess comparing DC to San Francisco, maybe still being a little higher than where I would have been if I was still in San Francisco.
Yeah, Jeanine, I was wondering, is there a coincidence that San Francisco is at the bottom of all these tables after you left that city and relocated? Coincidence?
You know, I can't say that that's the case, but you know, I think the volatility, you know, San Francisco tends to have that volatility, and DC, they sold me on its more steady Eddie. So hopefully that's the case.
Good answer. I think you avoided making enemies out of your colleagues in San Francisco. Well, so Matt, maybe same question to you. So Chicago is the best performing retail market amongst the gateway markets. So that's an important caveat, which puts it at about middle of the pack. Anything to add there, or any nuances?
I will tell you, this is the one that really surprised me, Will. And perhaps that's because I'm more familiar with the high street retail and the regional malls in the market, where the performance has not been great. But you know, it's a large retail market, a lot of GLA. My understanding of the data behind this slide is that I can't really understand the demand side, but on the supply side, there are only 600,000 square feet of new deliveries in the past year, which is about a quarter of the typical annual pace of deliveries. And 85% of that space is pre-leased. So that probably helped in how this market was scored for retail. But as I mentioned, you know, we're familiar with what's going on North Michigan Avenue in high street retail. That's our you know, a fashion district and a big tourist destination. And that street has really been decimated over the past several years. Vacancy, depending on how you count it, exceeds 30% now. Rents have really reset to much lower levels than they once were. Tenants have left, and so there needs to be a lot of work done to kind of fix North Michigan Avenue, and a lot of great minds and a lot of attention is being put on just how to do that. But anyway, just some comments there on retail from my view.
Yeah, that makes a lot of sense. And this is sourced from CoStar, and I believe their kind of average rent levels are square foot weighted, not dollar of value of real estate weighted. So maybe there is sort of a little more emphasis on necessity retail and to some extent kind of class B retail as opposed to institutional retail. So that could be why there's a disconnect a little bit from what, you know, institutions like us and institutional investors are seeing and how it's being reported here. You know, just one other before we flip on, the Boston market also performed reasonably well. Boston had some of the highest household income growth in the country, which was a little surprising to me when that data came out earlier this year. I think the life science sector has helped with that, but you know, outside of Boston, it's generally been the Sunbelt markets that have seen more of that household income growth, just again on a kind of percentage basis. So that could be part of the reason retail has done reasonably well there. So moving to multifamily, you know, the first thing that strikes me is boy, we could go back in time. Maybe it'd be nice if we could tell ourselves buy Florida multifamily, because the top of this list is certainly showing the migration patterns that we're all familiar with. You know, by either the RevPAR measure or the annual return measure, it's done well. You know, in Los Angeles, which is, you know, ranked 34 here, rent losses were more pronounced here than in most other markets during 2021, but there's been a bit of a recovery in Los Angeles in 2022. Vacancy in that market is at the lowest level it's ever been. And so that's one that, even though it is kind of middle of the pack, I'd say Los Angeles has been growing or doing better pretty quickly. If we were to sort of rescale this to just look at 2022, I think that's a market that would look better. You know, the San Francisco market again is the outlier in terms of that RevPAR measure, and that's again for kind of some of the same reasons that we talked about before with out-migration and just other issues facing that market. So Matt, maybe we'll start with you. Chicago is the best performing of the gateway markets here. Any detail to add on the multifamily situation in Chicago?
Well, I would say, despite the headwinds and some of the challenges we talked about earlier, probably the most important thing that influences multifamily performance has been the in-migration of college graduates and young talent. As I said, about 9,000 graduates a year move to our city, and they are all renters. They're, in largely some good paying jobs and can pay some of the rents that support some of these developments. So I'd say that's been a bright spot. One of the headwinds, of course, has been our real estate tax situation in Cook County, and where the city of Chicago resides, and taxes, of course, hit multifamily rents more meaningfully than a net leased office rent, since you can't pass through any of the increase in taxes to your residents. So the uncertainty around assessment methodology and amounts and resulting tax amounts has created, certainly on the investment side, some obscurity about where people can price deals. But looking through that, the fundamental performance of the market has been quite good. So I think our expectation is there's a handful of properties on the market or hitting the market in the first part of next year. We think that will deliver some comps and perhaps give some certainty about where things will price and how buyers are managing real estate tax assessment risk. And I think liquidity will return to the apartment market. So areas that we've kind of been focused on, we've done some multifamily development in some TOD locations in close-in suburbs, actually outside of Cook County, where the real estate tax situation is much more predictable. So we've liked that. We'll consider doing more of that. But I will say, with increasing costs and construction costs, and also increasing cap rates on stabilized stuff, trying to making sense of the development spread these days is a little more difficult than it used to be. Investors probably don't get paid enough to take construction risk based on the observable cap rate spread there. So we'll be watching that closely, but we've always been a very strong build to core apartment developer in our gateway markets and in other locations. So I would expect us to be watching that closely.
Well, good. Yeah, thanks, Matt. So Jeanine, kind of the same question to you on the DC market. I know one thing we had looked at earlier was kind of the rent premium or rent savings a resident would get if they're in DC and then move to a place like Southern Florida or Nashville or Austin. And that kind of savings was a lot higher a few years ago than it is today. So that could be a reason to think that, even though we're only focused on the pandemic trend in the chart that's up here, as that savings has compressed, maybe that trend will turn a little bit. So I don't know if you remember that analysis or have anything to
Right.
add there, or just anything else on the DC
Absolutely.
apartment market.
Right,
Yeah.
First off, these are respectable returns for DC, these numbers. And, you can see why multifamily generally is so in favor with investors based on this as well. And, I was, jealous of some of the higher numbers on the chart. And it made me think about, there was a flight to, a lot of Sunbelt markets, and certainly, like, weather-wise, we can't compete with those guys, but there was also a real cost savings to moving to some of those locations. And you helped me out with some data, the changes in rents. Let me just pull it up here. In 2019 to 2022, the Austin apartment rent went from $1,354 to $1,728, and Washington DC during the same period went from $1,858 to $2,077. And so essentially, the outsized growth that Austin has experienced has resulted in a halving of that differential. So it's a 37% difference in 2019 to a 20% cost savings in 2022. So I don't think people are like comparison shopping apartments on a daily basis across the country to see where they're going to get their best value. But, over time, as, folks graduate and they look at, it's only 20% less to be in Austin, for example, not to pick on Austin. They have a lot of great job growth there and a very desirable cultural scene as well. So that may be one factor that, folks consider, but seeing that spread isn't there as much, and maybe there is a salary differential as well that helps to offset that premium, I think you will see on the margin folks, opt for gateway markets again, because that immense value savings isn't there. And the other thing I would just say, costs have gone up. The cost of construction, the cost of labor, financing, the reduced availability of construction financing. And so, I am optimistic about the future because, the supply pipeline, which has been strong, particularly in DC, it, will likely slow down and, should lead to continued rent growth as the supply side reduces. And then there's just almost insatiable demand for more affordable housing in the region. So, we are looking for opportunities in more moderately priced housing, class A minus, class B, workforce housing, if you will. I think that is a spot that, there will never be enough supply to meet demand.
Good. Well, yeah, thanks, Jeanine. So just doing a time check, I think we're all going to get about 30 seconds on industrial. So just very briefly before I hand it over to you, Matt, just kind of at a high level, I think the first thing I'd notice looking at these returns might be to take back that comment about Florida apartments and instead just say buy industrial everywhere. We could go back in time 3 years ago, because the industrial returns have really been quite strong throughout the entire country, even the last place cities on here. Matt, maybe I'll start with you, because I know your team has been bringing a number of Chicago industrial deals to investment committee over the last year. Any thoughts in the industrial sector? Any nuances here?
Well, in the interest of time, I'll just say $1.3 billion. Chicago is a industrial market of 1.3 billion square feet, and it is centrally located. It's essential to railroad operations in the country. And fundamentals have been very strong in industrial. So we will continue to look at acquisition opportunities, development opportunities when they make sense. So we're very bullish on Chicago industrial.
Janine?
Yeah, I was pretty pleased to see our placement on that one. I'm sorry that that one had to go down so quickly, but I liked our placement there. I would just say really quickly, for us, it's scarcity. I think, perhaps there was a perception of lower potential for rent growth here. Our cap rates were a little higher, 25, 50 basis points higher than, the Southeast during the same period. But there's just a lack of available land, and there's a lot of competition for that land. So there's data centers, 70% of the internet traffic flows through Northern Virginia. So that gobbles up some amount of the industrial space. And then there's housing. A lot of those sites could be either industrial or housing. So I think that scarcity has driven, better returns than maybe would have been expected.
Okay, well, I think that we're kind of at the end of the hour. So, Chase, anything from you?
No, I mean, I obviously, I think a lot of questions came in. You guys covered a lot, so no additional questions from me. But I did want to make a quick note just to let everybody know, because I know one of the questions was slides being available, the recording. So all of this will be available. I guess just a general thought, a lot of those charts where different sectors are. I mean, one of my thoughts is just how much are we going to see a reversion to the mean? I think we talked about this before, from inflation to pricing, all of these different things. That's the gut feeling. It kind of, when you're looking at these charts, I think is one takeaway I had. But one thing we did want to do, have a few thank yous, obviously. I want to make sure we do that. So want to make sure to say thank you, obviously, to you three, for taking the time today. Want to say thank you to MetLife Investment Management, for making this possible, for the investor community. So again, all these slides are going to be available. The recording will be available, and we'll be distributing that out. So yeah, want to just say again, thank you to all of you. And then on behalf of us at IREI, thank you to all the attendees, to you guys as well. Happy holidays, and looking forward to 2023.